Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. First of all, let me wish you a very happy new year, and let us hope that this year turns out to be the year where we bury the ghost of coronavirus for good. We banish this pandemic from our lives forever and get back to living our lives the way we used to. It's a tall order, but definitely achievable. So let's just hope and pray for that. Now, coming to today's topic, up until recently, I was neutral on gold as an asset class, as an investment avenue. I was always of the view that gold is a yellow metal. It sits there in your vault. It sits there in your locker. It does nothing, and it's not productive at all. And stocks, on the other hand, when you're investing in Sensex, you're investing in some of the best companies in India with the best management, fast growing economy. Therefore, there's no chance that over the long term stocks can underperform gold, or gold, the yellow metal, can outperform stocks. But I was in for a bit of a surprise when I saw recent data. Over the last 15 years, between 2005 and 2020, Sensex is up a little over seven times. 100 rupees invested in the Sensex back in December 2004 would have become a little over 700 rupees, 723 rupees to be precise. And this is not a bad return. In CAGR terms, this is 13% return, little over 13%. And it's not a bad return at all. I think a lot of investors would give anything to have those kind of returns over the long term, over a 15-year period. But when I looked at the performance of gold during the same period, it was neck and neck. Yes, that's right. As you can see on your screen right now, gold and Sensex are pretty much neck and neck over the last 15 years. If Sensex has moved from 100 to rupees 723 between 2005 and 2020, gold has given 730, turned 100 rupees into 730 rupees during the same period. So, what do you make you make out of this performance of gold vis-a-vis the Sensex? Should we, are we underestimating gold as an asset class? Are we overestimating Sensex? Should we give up investing in stocks altogether and move to the relative safety of gold? Because at the end of the day, it doesn't require any effort to invest in gold, as compared to, say, investing in stocks where you have to research and where you have to enter at the right time, exit at the right time, and stuff like that. So, what do we make of this performance? Relative performance of gold vis-a-vis the Sensex. I'm of the view that gold as an asset class, I think, is here to stay. In fact, if anything, its prospects are better now than they were in the past because of all the currency debasing that's happening around the world. I'm no gold expert, but I hear a lot of experts telling that strongly recommending gold to be made a significant percentage of your corpus if you haven't already allocated money to gold. And at the same time, you cannot discard stocks altogether. I think Indian corporates, or the Indian economy, has the potential to grow at 12 to 15% in the foreseeable future. And since stock returns follow the returns, the earnings growth, even stocks have potential to give that much over the long term. So, both gold as well as stock, I think, are asset classes worth having in one's portfolio. Now, what if we combine the two? What if we combine gold and Sensex? Uh, One thing with the Sensex is that its performance has been more zigzag as compared to gold. Gold has been a lot less volatile over the last 14, 15 years as compared to the movement in the Sensex. Sensex has had a year where it has gone down 50%. It has a couple of years where it was down 25, 30%. So its performance definitely is more volatile than gold. Now, what if someone were to figure out, a way of playing gold and Sensex such that whenever there's a chance of Sensex giving negative returns, or Sensex crashing over the next 1 to 2 years, you take money out of Sensex and invest, put the money in gold. And this is exactly what I have done. If you see the next chart, what I have done is that whenever the Sensex has crossed a price to earnings multiple of 25 times, I have moved the money from Sensex to gold. Now, I've not done a complete switch over. What I have done is, if the Sensex PE is less than 25 times, say at the end of every year, if it's less than 25 times, you stay 75% invested in Sensex and have only 25% investment in gold. But as and when the Sensex goes up above 25 times, you do the opposite. You have 75% of the money in gold and keep only 25% in Sensex. Now, the reason I did this, I chose 25 as the benchmark, is because historically, whenever the Sensex has crossed a price to earnings multiple of 24, 25 times, the returns over the next 1 to 2 years have been negative. So it's always a good idea when the forward returns of Sensex has high chance of being in the negative, you switch from Sensex to gold. And because gold has been less volatile and it has usually done well in a year where the Sensex has not done all that well, this switch has worked wonders for the overall returns. As you can see, rupees 100 invested in a combination of Sensex and gold, such that whenever the Sensex PE is less than 25 times, you're 75% in Sensex and 25% in gold, and vice versa when the Sensex is more than 25 times, would have multiplied your money 15 times between December 2004 and December 2020. So over a 15-16 year period, you would have doubled your return by playing this combination smartly between Sensex and gold, and switching your allocation between the two asset classes based on the valuation of the Sensex. You would have earned twice as much money as you would have earned in these individual asset classes. And I think that's a very good return in my view, and it's a low risk way of playing both Sensex as well as gold. Now let's move one step further. What if instead of the Sensex, I build a value portfolio of mostly mid and small caps, and mix it with gold? So I won't invest in the Sensex now. My stock allocation would be towards mid and small caps, a value portfolio that's comprising of mid and small caps and gold in the same 75-25 ratio. Whenever the broader market is expensive, whenever the Sensex PE is more than 25 times, you have 75% of the money allocated to gold. You do this allocation just once a year. End of year, you see what is the Sensex price to earnings multiple, whether the broader market is cheap or expensive, and if it's less than 25 times, 75% of your corpus is invested in mid and small caps, a 20 stock value portfolio of mid and small caps, and 25% is in gold. And when the price to earnings multiple is more than 25 times, you do the reverse. You have 75% of the allocation in gold and only 25% of the allocation in value portfolio. Now let me tell you the rules for the 20 stock value portfolio that you were supposed to hold for 1 year. So at the end of say 2005, you create a 20 stock portfolio using these rules: a revenue of at least rupees 100 crores, an average 1 year liquidity of greater than rupees 1 million, so that you don't invest in low liquidity stocks. Stock has to have an average 1 year liquidity of at least rupees 10 lakhs, debt to equity ratio of less than 1 for the most recent year, so that you don't invest in value traps or bad quality companies. Best combination of dividend payout and debt to equity. Now what I mean by this is you rank the company based on their average payout over the last 5 years and the debt to equity ratio. So the company with the best dividend payout ratio will get a rank of 1, and second best will get rank of 2, and so on. Similarly, the company with the lowest debt to equity ratio will get a rank of 1, and next best company will get a rank of 2, and so on. So you combine the two, And the companies, the 20 companies which rank the lowest on these parameters, 20 companies which have the best combination of dividend payouts, good dividend payouts and low debt equity ratio, will figure in the portfolio value portfolio. And you have a price to earnings ratio of trading 12 months between 2 and 7 times. Now this is, remember, this is a value portfolio. You want a big margin of safety, so you don't want, ideally want any stock that's trading at more than a single digit price to earnings multiple. So the stock enters the portfolio only if it has a price to earnings multiple of between 2 and 7. So this is a value portfolio where you have a debt to equity ratio of less than 1, best combination of dividend payout and debt to equity, so that the company is of decent quality. And valuation multiples, price to earnings multiple of between 2 and 7 times, so that you have a big enough margin of safety. Now this 20 stock value portfolio alone, without any help from gold, would have done quite well between 2004 and 2020. So what you do is, at the end of 1 year, you invest in these 20 stocks, and at the end of the next year you sell, you come out, exit all the stocks, you invest, run the similar screen, and then you have another list of 20 stocks, you invest in them, and then you keep doing this every year. So have average holding period of each portfolio is 1 year, and you run the screen for 16 years, and this is what you get. Rupees 100 invested in the value portfolio would have multiplied 18 times. So this has done even better than the combination of Sensex and gold, which was up, as you may recall, 14 times, and of course done much better than Sensex and gold alone, which was up 7 times. So value portfolio has outperformed the Sensex, and it has also outperformed the Sensex and gold combination. Now here's where it gets really really interesting. What if you combine this value portfolio with gold in the same 75-25 ratio that I highlighted earlier, where when the broader market is expensive, you put 25% of the money into the value portfolio of mid and small caps, and when it's cheap, you put 75% money here and 25% in gold. Now, this portfolio between 2004 and 2020 would have multiplied a whopping 70 times. Every rupees 100 invested in this portfolio, combination of value and gold, 75-25 allocation, and you switch the allocation based on market valuation, would have multiplied your money almost 70 times, a huge 70 bagger. And those other worms that you see on the chart is a value portfolio which, as we just saw, was up 18 times, a combination of gold and Sensex, which was up 14 times, and of course Sensex and gold alone, which was up 7 times. So this is a big outperformer, and the magic of value and gold, I think it's phenomenal. Earning these kinds of returns without taking a lot of effort, by just trying to play with value and with relative valuation, can make so much of a difference to the overall returns. So this is something which is definitely worth considering. Now a few pointers here. This is of course all in the past. This is past data, and future performance may differ a lot, great deal, from what we have achieved in the past. But I think there is still a lot of merit in including gold into your overall asset allocation. If not 75%, you can have a combination of fixed deposits, gold, and a value portfolio. Even that portfolio, I think, uh, will do well over the long term. It may not go up 70 times like gold and value portfolio has done, but I think it has opened my eyes to a whole new way of looking at gold and looking at a value portfolio, and I think it will do the same for you. So do try this out. Uh, do try this study out for yourself if still having some doubts. But I have checked and rechecked, and I think I don't see any error in what I have done. The data seems to be pretty solid, and a combination of value and gold works wonders for in the long term returns. So let me know what you think of this study, whether you agree with this or not. As usual, I'll be looking forward to your feedbacks, to your comments. to your likes and of course to also your dislikes. So keep them coming, and let me know what you think of this study. And I'll see you around next time. Thank you so much.